Welcome to this explainer. Right now, we are staring down a massive, frankly baffling paradox in the market. UnitedHealth Group, UNH, is currently rallying over 30%. But here's the catch, they just printed an absolutely horrific Q4 earnings report. To figure out exactly what on earth is going on here, we're booting up a multi-agent AI simulation. We're going to let a team of specialized AI analysts, fundamental, technical, bullish, and bearish, battle it out to build a comprehensive trading blueprint. So let's dive right in. What you're seeing here is the live feed straight from our trading agent's dashboard. We're not just giving you a generic summary today. We are acting as quantitative journalists, pulling back the curtain so you can see the raw, unfiltered telemetry. We've got the market analyst, the fundamentals analyst, and the risk management agents all actively crunching the data in real time.
Okay, here is our system boot sequence. First up, we'll run the fundamental module. Second, the technical module. Third, we hit the debate matrix. And finally, we'll get the system's execution output.
Starting off with Module 1, the fundamental module, where we lay out the baseline data.
$10 million. Let that sink in for a second. That is the absolute shock value of UNH's Q4 2025 net income. To put that into perspective, a really busy local pharmacy might net that over a few years, but for a mega-cap healthcare franchise, dropping to a mere $10 million highlights an acute, massive margin collapse. It is a staggering piece of data, and our agents immediately isolated it.
When you look at the tier-by-tier net income decay, it is severe. It literally drops off a cliff from $5.54 billion at the end of 2024 down to $2.35 billion before the bottom just completely falls out to that 10 million figure. Operating income slashed to just $380 million. The entire fundamental debate right now hinges on this one question. Is this just a temporary margin squeeze, or are we looking at a terminal demand destruction issue?
And that leads us to this crucial valuation disconnect. The system contrasts their massive $449.7 billion in trailing 12-month revenue against the current PE metrics. So because of that terrible quarter, we have a really expensive trailing PE of 27.9, but we have a much cheaper forward PE of 17.8. The agents are essentially asking, is the market prematurely pricing in a clean recovery? That forward multiple assumes everything goes back to normal, but honestly, the recent data just doesn't prove that yet.
All right, moving on to Module 2, the technical module. Let's run through the strict indicator checklist.
Here are the exact mathematical parameters. The 10-day exponential moving average, our short-term trend, is rising incredibly fast at 355.19. The 50-day simple moving average sits down at 300.77, which confirms a medium-term recovery. But you've got to look at the momentum here. The RSI is screaming overbought at 82.86, and the MACD shows aggressive positive momentum at 21.47. The trading implication? The trend is intensely bullish for sure, but the mean reversion risk is literally rising by the minute. Let's map out the explosive timeline of this 30% rally. Back in early March, price action was incredibly weak, sitting below the 200 SMA. Then, by mid-April, momentum shifted violently, driving that RSI up into the mid-80s. And by early May, we saw an explosive breakout, reaching 368.78. UNH dramatically reclaimed its long-term benchmarks, but as the system points out, it rapidly became incredibly stretched relative to its trend. The market analyst agent is leaning heavily into that overbought RSI reading of 82.86. But even more concerning, the price is roughly 36 points, almost 11%, above the Bollinger middle line. That line acts as a historical center of gravity. While strong trends can definitely persist, being this overextended creates a wildly high probability of a really painful mean reversion pullback. To manage that exact risk, the agent isolated the ATR, the average true range, at 9.35. That means a swing of roughly 9 points is just a standard daily move right now. The big takeaway? You absolutely must use volatility-adjusted stop-loss placements based on this 9.35 figure. If you don't, the normal daily noise is just going to shake you right out of your position.
Now for Module 3, the debate matrix. It is time for a strict cross-examination between the bull and the bear.
Let's pit their core arguments directly against each other. On the left, the bull agent is championing UNH's enormous defensive scale, $17.7 billion in trailing free cash flow, a spot on the Goldman conviction list with a 435 target, and an unparalleled revenue base. But on the right, the bear counterattacks hard. They point out a negative $24.3 billion in working capital, a heavily leveraged balance sheet with a debt-to-equity ratio near 74, and a looming DOJ regulatory overhang that could completely cap the multiple. Diving deeper into the telemetry, we hit what is arguably the most legitimate long-term risk, Medicare Advantage. The critical debate here is whether the Medicare Advantage underwriting cycle is actually bottoming out. The bulls are arguing that sector-wide strength means the worst is over, a classic shrink-to-grow phase. But the bears? They argue this segment is under severe pressure, and if underwriting isn't truly stable, this whole recovery narrative shatters completely. And here is the bear agent's kill shot. The bear argues that the bull is dangerously mistaking a cyclical normalization for a permanent inflection. Sure, the market is getting all excited about a potential bottom, but they are relying on forward multiples that simply haven't been earned yet. The bear warns that buying right now means paying a premium for a recovery that still desperately needs to be proven.
Which brings us to Module 4, the execution output. Let's see how the portfolio manager reconciled this debate.
The system's final verdict: a definitive hold. Ultimately, the conservative analysts won out on the entry timing. The underlying franchise quality is undeniably real, but the risk asymmetry at these extended levels, with the RSI above 80 and the price floating so far above that Bollinger midline, it just makes it way too dangerous to initiate a fresh buy right now. So, what is the exact execution blueprint? Step 1. Maintain your core position if you already have one. Step 2. Absolutely do not chase this stock above 368. Step 3. Target your entry on a pullback toward the 10 EMA near 355 or wait for much clearer margin stabilization. And step 4. Always set your volatility stops using that 9.35 ATR. Having a rigid, multi-stage execution framework like this is exactly how you take the emotion out of trading. The portfolio manager actually integrated the bear's uncompromising conclusion directly into the final report. Quote, UNH looks like a hold at best, not an attractive buy at current levels, and the market is underestimating how much can still go wrong. It is a stark, honest warning against chasing a euphoric technical rally when the fundamental bedrock beneath it is still showing some pretty massive cracks. Which leaves us with the ultimate question as we look out over the next 3 to 6 months. Will the Medicare Advantage cycle actually bottom out to justify that optimistic 17.8 forward multiple? Or will the sheer weight of this massive technical overextension break the 30% rally and force a really painful reset? Definitely keep a close eye on that 355 level. Thanks so much for joining me on this explainer.